We're Compound Everything. We talk money, markets, and investing generally. And today we are doing a book review on what we think is our best read in the past few years.
Yeah.
So the book that we're going to be talking about is called The Davis Dynasty. And it's a book that is not that popular among the investing community. Maybe it is among professionals.
I think I stumbled on it, or you stumbled on it. One of us stumbled on it. A Reddit forum.
Yes.
Interestingly enough. Mm-hmm. And I thought, wow. And I think the person said, this is the best investor you've never heard of.
It's a book about an entire generation, 3 generations of value investors.
Mostly centers around Shelby Cullom Davis, who's
Yes.
the kind of the senior.
Yes.
And how he kind of got his family started in the investing game, let's call it.
We've gone back and referenced it plenty of times, and the book is underlined on numerous pages. So what made us love this book so much?
It just recounts the life and the investing philosophy of Shelby Davis. Just going back to the notes part of things, in the book, actually, I wrote several notes where it talked about euphoria and stuff like that. And I wrote notes in 2021 as to, wow, this looks like now. And we know what's happened since 2021 to 2022. Yes. The market has come down a fair amount.
Yeah, and there's a lot of people who bought into speculation.
Yeah. So from that standpoint, even reading the book, just to kind of get a view of the macro environment that you can see was running away at the time when Shelby was investing.
Yes.
It's good.
One of the reasons I love the book and why I recommend it to everyone is because it was very, very informative. If you're a value investor, it had a lot of information and education within the book, but it wasn't boring to read.
No, it's
because
great.
It was also a biography,
right?
And it followed the family's history and the family's interactions with each other. So within this biography, which was quite interesting to read as you went through the 3 generations of Davises, there was so much, it was packed with so much education. So I found it one of the easiest value investing books to read through, but also one of the most educational.
Yeah. So one of the family members, Chris Davis, actually still runs a fund. I can't remember what the fund's called off the top of my head. But interestingly enough, he is actually, you can hear him ask a question at one of the Berkshire meetings in the 90s. So we digress. The point being is Shelby Davis is probably one of the best investors, again, no one's ever heard of.
Yeah.
His claim to fame, in a sense, is that he, over a 47-year track record, he started his investing at the age of 38. And I think around the 1940s, late 40s. He started with $50,000 and turned that $50,000 into $900 million.
Yeah.
Over 47 years.
Yeah. So what is that compounded annually?
23%.
Yeah.
I knew you were going to ask me that. So I worked it out.
So you were ready for it. Okay.
Yes.
Fair enough.
So 50,000 to 900 million. That's no small feat. 47 years.
47 years. Yes. So in the book, the author actually refers to Shelby Davis Sr. As Davis.
Yep.
And then he refers to his son as Shelby. So we'll do the same to keep it less confusing.
For sure.
And then Chris is the grandson.
Yes.
Just for anyone watching who's not familiar with this family.
Right.
Now, Shelby, to go back to that statement where you said this is the best investor you've never heard of, Shelby, he actually didn't want to be well known.
Oh, I didn't know that. Okay.
Yeah, it's in this book.
I think you meant
comment,
sorry, I knew that.
It's a little line in this book where he wanted to not be on the Forbes list. He didn't want everyone to know who he was. So, you know, and I think in one sense, one of the reasons why no one's really heard of them is because they maybe went out of their way to not be in the spotlight.
Fly under the radar.
Yeah.
Makes sense.
Yeah.
So Shelby Davis, he was a value investor at heart. So the big question in everyone's mind, hopefully, is how did he do it? How did he multiply or compound $50,000 into $900 million? Well, he took a value investing approach. So first, he was mainly in insurance. Actually, I think he started as a historian, but then got a job, from my understanding, as an insurance kind of regulator.
Okay.
And so he kind of understood the insurance industry.
And this is Davis.
This is senior. Yeah. I'm only going to talk about Davis Sr. From this standpoint, because I think he's largely the one responsible for the compounding. And so he took that money, he took I think it was $50,000 from his wife, Catherine, and then he put it to work. And he bought mostly insurance companies initially. And so his investing approach was actually quite simple. So he would look at the insurers. And so that was obviously an industry he understood. And by the time he could kind of figure out the balance sheets and stuff like that, he knew he kind of found the mother lode. So he would look through the insurers and see if they were making money or they were losing their shares. So they had to be profitable.
Yep.
So that was criteria.
Which is a very big criteria for most value investors. Yeah. They want profitable companies.
Right. So they have to be profitable. Secondly, once he determined whether the company was profitable or not, he would look at what assets were on its balance sheets. So he would look for things like government bonds, blue chip stocks, and things like that. And then, what proportion of their assets were those kind of things. And then what part of their assets were more speculative in nature or just maybe kind of junk. Mm-hmm. And so he kind of teased those out a little bit. So once he did that, he made a rough guess as to what the private value of that business would be. So if someone were to take it over, what would they be willing to pay? So a larger insurer.
And I feel like that was actually part of the book that you really appreciated. Mm-hmm. He looked at the private cost. I remember you saying that when you read it, that Davis always wanted to know what a private business would purchase this company.
Right, what would they pay for it, right? Mm-hmm. And so once he did all that, then he would go ahead and develop his own value calculation for the company. And if it was trading at significantly below what he thought was a good price for it, then that would lead him to then actually go to talk to management.
Right, so scuttlebutt.
So he did some scuttlebutt.
It's so interesting to watch all these value investors from years, decades past to now, and they all look at the same things, and they all do the same thing, and they kind of do it all in the same order. Right. It's very interesting.
Yeah, so it all just works. And so once he developed it, he assessed that there was a large margin of safety, he'd go talk to management, and if he liked that, he'd buy. Mm-hmm. And he'd buy, sounds like hand over fist.
Now, one interesting thing is you mentioned Geico. Mm-hmm. And now Davis wasn't really an emotional investor, or he tried not to be. Most value investors try to keep their emotions out. And you have to if you're a value investor because you're going against the crowd.
Now, notably, the interesting that kept his emotions out of it is that he did develop his own valuations.
Right.
And so because he valued the company, what he thought or knew it was worth, when it dipped, he didn't care.
Right, because he knew.
Because he knew it was worth more than what people were willing to pay at that time.
And because it was profitable.
Because it's profitable.
He also had a rear view mirror to look at.
That's right. Yeah.
So one thing about Geico, though, is that he actually sold his position.
Yes.
And he regretted that till the day he died. It said in that book that he regretted selling his entire life. And what happened with Geico is he actually lost money on it.
Yeah.
And he ended up selling.
Yeah, I think he got bitter.
He got bitter. Well, we all know the story of Buffett coming in. And when you read it, it says in the book he was too angry. He was upset about all that. And I can't remember all the details and the nuances, but he was upset about something that happened. He said, well, had I known, X, Y, Z, I would never. But it said he was too angry to buy back in.
Interesting.
And he regretted that the rest of his life.
So he did make an emotional decision then.
In that position he made. And it was just interesting because that was when Buffett was in. And I always wonder if him and Buffett ever talked, if they were friends or if they I
think they came across each other.
Well, they obviously did, but I often wonder was there bitterness there? It doesn't talk about that. It just says that it just mentions Buffett in passing, and then it goes on to say that he regretted not buying back in his entire life.
Interesting.
But he couldn't buy back in.
Right.
So it's not like he missed the value.
Right.
He didn't buy back in because he was angry.
Right. And
then he regretted that. So it does show these guys do have emotions.
Yes.
And sometimes they
get the better of them.
They get the better of them, and then that was a big mistake of omission for him.
Right. You got to keep emotion out of investing, basically. So one of his approaches, again, was just to kind of double back, is to know what the intrinsic value was. And so he was kind of steadfast in down markets. Mm-hmm. He just didn't care. Now, at one point, I don't know how many stocks he had in his portfolio generally. I think later on he tended to carry more. But at one point, kind of in his beginning of his career, he'd have about 30 stocks generally. He tried to keep it low, just because that's what he could keep his pulse on. Is right. My understanding.
Especially because he did so much scuttlebutt talking to the management. You can't do all that. You can't, you can't be keeping such a close eye on companies when you have hundreds of them.
Right.
It's just you don't have time.
Right. Now later on in his life, I think he developed quite a collection of things. As time went on. But I think in the beginning he was fairly concentrated. So again, you see this standard pattern of is it a business I can understand? So these are his criteria. Is it a business I can understand? Does it have a good margin of safety? And is it run by someone I trust? Those three factors are what led him to compound money the way he did.
In an extraordinary way.
Yeah.
Now, Davis actually started his investing career out of the gate he was doing really well just because of the environment in which he started.
Yeah.
Whereas his son Shelby was opposite.
Right.
He started investing when the market was not doing so good. So what is intriguing about that is that both Davis and Shelby had amazing returns, even though they started in completely different macro situations.
Right.
So it shows me that value investing works no matter what. The macro doesn't matter.
Right. No, I don't.
It's just different.
Yeah. I think, now having said that, I think there's times where he recognized that the market was kind of getting overheated and really didn't do much.
Exactly.
He kind of sat on his hands, which I think is probably a very prudent course of action in many ways, many times.
Right.
So thinking of the current macro environment, it's actually a quote from the book. It says, one of his sayings was, "Out of crisis comes opportunity." And it says, "A down market lets you buy more shares in great companies at favorable prices. If you know what you're doing, you'll make most of your money from these periods. You just won't realize it until much later."
So the macro, I mean, obviously the macro matters if everything's going bananas. But at the same time, it doesn't matter because even when everything's going bananas, there can be stocks that are undervalued.
Oh, for sure.
Right? And even when it's super depressed, there can be certain companies that are wildly overvalued. When you talk mostly about Davis, I actually found Shelby's investing career more interesting than Davis, probably because it was closer
to where we are,
to our time frame.
That's right.
I like Davis's life better.
Yeah.
Right? But Shelby, so like I said, Davis started with 5 great years.
Yeah.
And Shelby actually started with 5 bad years.
Oh, yeah.
And there's quite a long stretch about how discouraged he became.
I can believe
He became super discouraged. And I was reading this in 2021, I was like, this is crazy. Is the market ever going to come down? Are interest rates going to stay at like 0 and 1%, 1.5%? It's just, and there's a part in the book where it talks about interest rates quite a bit. And like you said, it was the exact same environment. And it talks about how Shelby was getting discouraged, Davis was getting discouraged. And it's just a reminder that value always comes back.
Value comes back, yeah.
Mr. Market is emotional. Right. And eventually he comes off his euphoric highs.
Yeah.
And crashes and burns. Right. Yeah, exactly. Yeah. So a few interesting things about Davis and his life is that he was so frugal.
Yes, I actually had that as a point.
He was so cheap.
Yeah, he had like holes in his shoes.
And his wife, Catherine, who also actually had the same money mindset, but not quite as frugal as him, would throw out his shoes, which had holes in them, and he would go and retrieve them from the garbage. There was one point, is it his grandson? I think he took out, was it Chris?
Yes, yeah.
He takes his grandson out, and his grandson asks for a hot dog.
Yes.
And then he gives him this lecture about, if you take that, whatever, I don't know, $1, and you compound it this much over this many years, it's gonna be $1,300 or something like that. And he said, "Are you so hungry that you're gonna spend $1,300 on a hot dog?" And tongue in cheek, Chris says in an interview, I guess it's written in the book, that he learned 2 lessons that day. He learned how much something can compound, and he also learned that you should always bring your money if you're gonna want lunch.
With your grandpa.
Yeah. So he was just a cheap guy.
Yeah.
So one of his big sayings was, $1 spent is $1 wasted. So he obviously hated spending money.
Yeah.
So if you're like that or not, that was how Davis was. He was just, frugality was ingrained within his very nature.
It was just in his being.
Yeah. And then another thing about him is that he was married to his wife for very many years. And this is the only investing book that has ever made me tear up while reading.
It was indeed.
And it was sweet to read about. So him and his wife had quite a great relationship. Well, he got his original investment seed from his wife's family. Yeah. From Catherine. How much was it? $50,000. And then he turned that into $900 million, which is crazy. He trusted her with the family finances because at one point she buys a house. Yeah. And he just lets her go in. Yeah. I don't think he even saw it. He didn't even see it. He just, which might not sound like much, but in that era of when they were living, I don't think that was a common thing to let your wife just go and purchase an estate without actually the husband even seeing it. Yeah, right? Sight unseen. Yeah. Eventually he handed his seat on the New York Stock Exchange over to his wife in name only. Yeah. But that was because he trusted her. Right. And actually, side note on that, I think that was one of his best investments, was buying a seat on the New York Stock Exchange. Yeah. He bought it even before he started his investing career. Yeah. And then the part that made me tear up was when he died. Yeah. It talks about his death, and then it says Catherine gave an 8-word eulogy at his funeral that said, "He was my best friend for 65 years. Oh, and then I was like, oh, that's so sad, and started tearing up, and I thought, oh wow, I've never cried in an investing book before. So it's the first and probably only investing book that will ever make me cry. For sure. No, I agree.
So one of the take-homes, well, there's two real big take-homes that I took from the Davis Dynasty. And the first one, and you have to be careful with this, is he actually really liked margin. And so he would get to the point where he'd margin up to 50% of his portfolio, or thereabouts anyways. And so I was thinking about that and just kind of, why would he do that? Thinking about why would he do that? But I think because he was so confident in the value of his assets, he didn't really view it as a risk necessarily in that respect. Because he was buying, 50-cent dollars, he knew these assets he was buying were worth double or, maybe triple what he was paying for them. So he thought, well, leverage of, 50% on assets is not bad. Mm-hmm. Now, again, I would be very careful with that because Buffett has seen very good investors, he's commented on this, he's seen some very good investors blow up because they did.
Wasn't there a friend that they had or someone on Berkshire?
Yeah, that's what I'm thinking of.
Blew up with margin?
Yeah, and then Warren bought all of his shares.
Oh, that guy. Because you got to call, right? You got to
something like that.
Yeah. Buddy. Yeah. So,
but anyway, there's a story about that. Mm-hmm. Look into that a little further. But the point being is he was able to partly enhance his returns because he used margin. And again, philosophically, because he was investing in kind of 50-cent dollars, I think he probably took the point of view that it's not risky for me because my assets are worth a lot. Now, having said that as well, as an aside, there was one time his portfolio dipped about 50%.
Yeah,
so he went through some pretty steep drops, although thankfully that recovered for him.
It is not totally uncommon, though, for some of these guys who have made a lot of wealth to do it on some sort of debt. Mm-hmm. So Shelby was big into margin. Right. Again, that is not any sort of advice. We are just recapping people's personal stories. And then Li Lu actually used his student loan to invest.
Yeah, he used his student loan and generated $1 million while he was...
I can't remember how much the loan was.
In Colombia. Yeah, I don't know.
Yeah, and then Manesh actually started his company with credit card debt.
Yeah. Well, and in his view, he was thinking, well, if it doesn't work out, I'll just declare bankruptcy. And bankruptcy laws at the time were very favorable.
Exactly.
And so it would have wiped out his credit card debt. No problem.
Right. So there's obviously a time where maybe it is advantageous. If it's a heads I win, tails I don't lose much. It's just interesting to think, like, we always think these guys are very risk adverse, which they are. Yeah. But there are obvious times where, they do something to the average person. It might look really risky, but they knew at that moment for some reason it was not risky enough for them not to. The probabilities were in their favor.
Right. It was a calculated risk.
Right.
Yeah. So the other thing I took home from the book is the concept of the Davis double play is what he called it. And so basically what the Davis double play is increasing earnings resulting in multiple expansion.
Right.
So what does that mean?
Right. What does that look like?
What does that look like? So what does that look like? So essentially the book gives an example, and this is pretty powerful. So it's a hypothetical, but this is exactly what he did. So let's say you buy ABC Insurance Company, and ABC Insurance Company is trading at $4 per share, and it's earning $1 of earnings. Okay. So it's got a PE of 4. Okay. Profitable, etc. So he would take, let's say, a $4,000 position. He'd invest $4,000 into that, 1,000 shares. And then he'd wait and see what happens over time, because oftentimes their earnings would increase dramatically. And so let's say their earnings, this is the example in the book, increased to $8 per share. So it increased...
Which in a good company would not be unlikely.
Not be unlikely at all. Earnings over time, that's a good business. It increases now, they're making $8 per share as opposed to $1 per share. So that part of things will drive up the stock price. But the other thing that tends to happen as well that he noticed, the market tends to start looking at the company more favorably. So instead of paying now 4 times earnings for this company, they're now willing to pay 18 times earnings for the same company. So he's had not only expansion in earnings, he's had multiple expansion as well, which now takes, this math is crazy, which now takes the share price or the value of his assets he bought for $4,000 to $144,000. Yeah.
And that's why he liked to do that.
And he was collecting dividends the whole time.
Right, which is even, makes your return even bigger.
Which is gravy.
Yeah.
Right?
Yeah. And we've heard a few guys talk about this Davis double play. They just don't call it that.
Right.
But we like to call it that because it has a nice...
It's the first time I ever really thought about it in that way, but it makes total sense.
Yeah. Now, on page 170, I think it is, around there, he actually talks about how the Davis double play can work in reverse against you.
Okay.
Yeah, and that is, of course, just going to be the exact opposite. You get caught up, you get swept away. 2021 would have been a perfect example of that. So it was one thing that they did mention. I took note of that they said the double play is fantastic, but beware, it can work in reverse.
Right, and that makes sense. But I guess that's where the margin of safety comes in.
Of course.
Right, so value investing.
And a value investor shouldn't be buying something. They should know that their company is, I think Lulu said he likes to know what they're going to do 10 years out, right? So you should be doing enough
due diligence
to know accurate and complete information.
Yeah.
There was a little portion in the book, can't remember where it was, but they talked about 3 things that Davis kind of banked on in order to make his money. So I'm just going to use my notes here just so I don't mess them up. So number 1 was stock prices ride on a company's earnings or lack of them. So that obviously was covered in what you just talked about. Number 2, earnings ride on the U.S. economy. So he was very don't bet against America.
Because similar as Buffett.
That's what I thought of. It says the reason to be bullish on stocks is that the U.S. economy has a habit of doubling in size every 16 to 18 years, going back more than a century.
Oh, okay, wow.
Okay, so, and then here was one more point. And by the time I got to this point, they were also talking about Shelby.
Right.
So I'm not sure, like thinking back, because it's been a while since I've read the book, if this was points that Shelby wrote or Davis. But either way, they stuck out in my mind.
Right.
Number 3 was, if history repeats itself, speaking of the U.S. economy, the economy will expand 8-fold during the adult life of the average investor. An investor can then expect a return during their lifespan of about 8 times, right?
Yeah.
He said, but probably better if you can get in the companies when they're depressed.
Oh, wow.
So that was very interesting to me because I was like thinking, it's very much a Buffett thing, like do not bet against America. That was pretty crazy. Every 16 to 18 years, the U.S. economy doubles.
Yeah, that's like phenomenal.
Right? No, I mean, the U.S. is becoming a more mature country as time goes on.
Yeah.
So maybe we won't see the same. If you believe that earnings ride on the economy and you believe that U.S. is a strong economy, then, but maybe there are other economies that you...
Right, maybe there's some emerging markets that you feel comfortable investing in and you see good growth and opportunity
A lot of people think India is an excellent emerging market. And if you believe that economy is going to grow and that economy is great, then stocks rise on earnings and earnings rise on a strong and good economy.
Right. Interestingly enough, just as an aside, he made a lot of his money actually investing in Japan.
He did.
Just after the war.
Yeah.
And so he found a lot of insurance companies there. There was, instead of being, let's say 10,000 insurance companies, there's very few of them and they had significant market protection. And so he found just a gold mine in Japan.
He did very well in Japan. Yeah. And actually he went there with Catherine. He took his wife. And after they went and checked out all those insurance companies, a bunch of people went out that he was with and whatnot, other investors, I guess, or maybe people from the insurance company. They went out in the evening together. And he actually stayed in the hotel with Catherine.
And crunch numbers.
And crunch numbers and talk to her about it.
Yeah.
And again, that's just one more reason why that story of him and Catherine was endearing.
It was just an endearing story.
Instead of going out with the guys and talking, he stayed back with his wife and they talked together.
It was beautiful.
Yeah.
So, I mean, that's all I had. I don't know if you had anything else.
Those are the biggest things. I mean, I loved this book so much. It might be my top investing book, more than The Intelligent Investor.
It's taught me a lot of philosophical points, I think, about value investing and whatnot. It'd be definitely a good book to reread again, especially, I mean, now that we've gone from a market high to a kind of a market low, and I don't know if it's the low-ish, but
I don't think it's the low.
I don't know if it's the low yet.
We're getting to the low. I don't think we're there yet.
But the point being, it's a good philosophical book for a value investor to read and just see someone who's kind of gone on before and how they did it and whatnot.
And so it's very surprising that this book is not more known.
Yeah, and same thing with Davis as well. For Davis as a value guy, I guess the less attention that was drawn to him, the more he could kind of operate in the shadows. Probably is better for him as an investor in generating returns.
Right. So I think that's kind of everything. Not everything, but a short glimpse into it.
Yeah, a great book.
So just for anyone who's interested, the exact title of the book is The Davis Dynasty, 50 Years of Successful Investing on Wall Street, and it's written by John Rothschild. So
if you're interested in value investing and you like biographies, you want an entertaining read, definitely one to look at. Definitely. So that wraps up our discussion, and that's our insight into what has been probably our favorite read in the past few years. Yeah. I haven't found one that has topped that book yet. Yeah, not in the same way. Not in the same way. Yeah. So if you have any great book recommendations that you would like to pass on to us, we would love to hear them. You can leave them in the comments, and you can like and subscribe to this video. We will see you in the new year.